A few years ago, an investor bought a $147,000 property in Detroit. On paper, it looked like a 9% return, but they didn't verify the Wayne County tax assessment. The real taxes were almost double the estimate. That one mistake turned a cash flowing investment into a $300 per month loss. Not because of the neighborhood, not because of the tenants, because of the structure. If you're thinking about investing in Michigan real estate, you're probably worried about an expensive, embarrassing mistake that you don't see coming. That's the right thing to be worried about. And this video is going to show you exactly how to avoid it. Later, I'll show you what a properly structured Michigan real estate deal should look like and the specific criteria it should meet before you even consider pulling the trigger. Welcome to Michigan REI. This channel is built for disciplined Michigan real estate investing. We analyze Detroit, Metro Detroit, and statewide markets through one specific lens. Structure first and property second. Not hype, not flipping highlight reels, frameworks that hold up when the deal gets hard. If you're serious about investing in Michigan real estate in 2026, stay with me. This video gives you the full foundation. Michigan remains one of the most interesting real estate markets in the nation for one reason: diversity of opportunity. As of early 2026, Michigan's median home price sits around $255,000. The national median, approximately $423,000. That pricing gap creates entry opportunities, but price alone tells you almost nothing. What actually matters is rent to price ratio. Here are two real investment profiles from the same state. Let's look at Detroit. You can get a property for, let's say, $140,000 purchase price. This property can rent for probably $1,450 per month. That's a 12.4% gross yield. If we look at Ann Arbor, the average purchase price there will be $420,000. This property in Ann Arbor can get a rent of $2,200 per month. That's a 6.3% gross yield. The same state, but completely different investment logic. Different capital requirements, different investment profiles, different risk surfaces. And this is where most beginners get confused. They treat Michigan like it's one real estate market. It isn't. In a few minutes, I'll show you exactly how to read the difference and which segment matches your strategy. Let me show you exactly how beginners choose wrong. Investor failure 1. Investor A buys a short-term rental in Detroit without checking the local short-term rental regulations. The city requires a license, but they don't have one. The property sits idle for 6 weeks while they sort that out, and this puts them already behind on their financing. Investor failure 2. Investor B buys a Section 8 property without understanding HUD inspection requirements. The unit fails inspection on move-in day. That leaves them with no rent for 8 weeks. Investor failure 3. Investor C tries the BRRRR method without budgeting a realistic rehab. They estimate $25,000 while the actual number is $41,000. The refinance doesn't pencil and now they're stuck. All three blame the market, but the market wasn't the problem. The strategy was. And the strategy was chosen before they understood the rules of the game. In Michigan in 2026, there are 4 primary investor pathways. Each has different capital requirements, risk profiles, and operational demands. For the buy and hold method, it requires moderate capital, low to medium risk, but there's steady cash flow. The BRRRR method has lower capital upfront, but high execution risk. However, there's a high ceiling if it's done right. Section 8 can get you a stable income, but tenant screening and property condition are critical. Short-term rentals, there's high variance and it's regulation dependent. You must choose your pathway before choosing your property. The property has to fit the strategy. It's not the other way around. And in a few minutes, I'll show you exactly which criteria your first deal has to meet, regardless of strategy. Step 2. Market segmentation. Michigan is segmented in a way that most investors from out the state fundamentally misunderstand. Detroit is block by block. These two streets are 8 blocks apart. Different tenant quality, different vacancy rate, different insurance tier, different appreciation trajectory. Standard zip code analysis completely fails in Detroit. On the other hand, Metro Detroit suburbs, places like Warren, East Point, or Roseville, they give you more consistency. They're easier to underwrite and they're easier to manage. On the other hand, College towns like Ann Arbor operate on different fundamentals entirely. There's lower yield, higher appreciation, and lower vacancy risk. Vacation markets like Traverse City are yield plays with seasonal volatility built in. If you mismatch strategy and segment, your numbers don't just shrink, they collapse. Step 3. Run the numbers. This is where most investors lose money, and it almost always comes down to one thing. They trust headline cap rates. Let me show you what I mean. Here's a Michigan rental on paper. Purchase price, $150,000. Listed cap rate, 10%. Rent, $1,450 per month. 10%. Looks solid, right? Now let's run the actual numbers. Gross rent, $17,400 annually. If we estimate vacancy at 6%, you can subtract $1,044. Property taxes in Wayne County, minus $3,800. Insurance, minus another $1,200. If we leave 5% for CapEx reserves, minus another $870. That leaves us with a net operating income of $9,616. That's a 6.4% cap rate, not 10. Headline cap rates are usually calculated before vacancy, before real taxes, and before reserves. They are marketing numbers, not investment numbers. The investor who loses $300 a month isn't unlucky. They just ran that headline number and stopped. This is exactly how that Detroit property I mentioned turned from a 9% return to a $300 per month loss. Step 4. Financing alignment. Your loan product is not a detail, it is a strategic decision. Here's how the 3 most common loan products in Michigan actually compare for investors. Conventional loan products are built for clean credit borrowers and standard rentals. There's typically a lower interest rate, but PMI applies when your down payment is under 20%. FHA loan products are best for house hacking, but owner occupancy is required. There's a lower entry point into the deal, but you have to be on site. DSCR, this is the investor's loan product. The qualification is based on the property's rent, not your W-2 income. There's a slightly higher rate, but the math changes entirely for non-traditional income or a portfolio play. The difference between a conventional loan and a DSCR loan can change your cash-on-cash return by 3 to 5 percentage points before you've touched a single thing about the property. Investors who treat financing as an afterthought are making a structural mistake before the deal is even signed. This is why it's important to choose your financing tier before you start making offers. What your first deal should look like. Here's the standard I use when evaluating a first Michigan real estate deal. If this deal requires perfect execution to succeed, it's the wrong deal. Your first Michigan investment property should be able to survive a mistake. What does that even look like concretely? Let's go through the criteria. Let's look at a property in a metro Detroit suburb, something in the $130K to $175K range. This can get market rent between $1,200 and $1,500 per month. You should already know if you're going to be using conventional or DSCR financing before you even start searching. This should also be a neighborhood you can drive through and understand immediately. And after running the numbers, it cash flows at 6% in the conservative scenario, not the optimistic one. Financeable, predictable, repeatable. And that last word is the most important one, because one deal isn't the goal. The goal is building a system that you can run again. Investing is controlled repetition, not gambling. That 147K property that we started this video with, the investor had the capital. They had the market, but they didn't have the structure. That's the only thing this channel is about. You now have the framework. The next step is running it on a real deal. The next video in this series walks you through how to analyze a Michigan real estate investment property in under 5 minutes, using the exact same line items that we just covered. Make sure you watch that video next. And if you want help structuring your specific situation, your capital, your financing tier, and the right Michigan market segment for your goals, there's a link below in the description to sign up for a structured strategy session. Remember, structure first, property second.